For investment properties, it's not an emotional decision for us. The stock market crashes is investors seek safety in bonds, and the seller didn't want to sell to us because we were like the third highest bid.
Because you thought out of the box.
Yes.
When traditionally, or maybe most people, they're thinking about prices only.
Yeah. Underwriting is an art and a science. It's not just a science. Last year, end of last year and beginning of this year, I actually went into like really intense burnout.
One person changed my life, and we're talking about Veena Jetti. Veena Jetti is a person that has done $1 billion in transactions in the multifamily space, and I have the privilege to do a podcast and interview her and ask like deep questions that people talk in the multifamily space. So stay tuned and watch this podcast on how I am interviewing the queen of multifamily, Veena Jetti.
Veena, thank you so much for being with us. You know that this is a dream comes true. I'll tell you. I had this conversation with Danny the other day, because I remember that when we met each other like 2 years ago, it was an event, and I was with my daughter, Christina.
Yes.
I remember that you gave her an advice that she is still thinking on it.
What did I say? Oh my gosh, I'm nervous. What did I tell her? Was it good advice or not?
I mean, you just told her that, it's important to follow our steps, and real estate is going to be something that is going to change her life.
Yeah.
Because it happened to you when you were a kid,
It
right?
did. It did. It totally changed my life.
Yeah, because your parents started the business, right?
Yeah, I actually read this quote the other day, or maybe it was a video, someone was talking, and they said, you are one relationship away from an entirely different life. And I think about that because, that's exactly what it is, right? You meet that one person that changes your path, and now all of these possibilities open up to you, and that's like, whew.
Yes. And actually, that's exactly what happened that day.
Yeah, I is the reason I do what I do.
Yeah, I remember that someone told me about you. I didn't know who you are or who you were at the time. And then I met you, and I noticed immediately that you weren't faking. You were like so transparent in the relationship. You wanted to talk with us, not only with me, all the people that were
everybody.
Everybody.
Literally everybody.
Yeah. And that makes me feel to start to follow you. And then I understood, wow, she has a lot of knowledge. She has the experience. And just being that room in the right moment changed my entire life, because after that, I started to do syndication. I started to meet other people. I went to your mastermind. I'm one of your OGs.
You're the OG. Yep, you're an OG.
So, I learned a lot. And because of that, I have a lot of questions.
Okay, let's get all the questions.
Has a lot of questions. Let's start with the first one. And it's related in the acquisition process about exit strategy. How do you decide between refinancing, selling, or executing a 1031 exchange in multifamily property, and what key factors weigh the most in that decision?
Okay, so how do we decide when we're acquiring a deal how we're going to exit? Favorite answer? It depends.
It depends.
Right? And here's why. Because sometimes you acquire a deal with such good debt on it that you don't want to refinance or even exit in your normal time frame of your normal buy box. Other times, it makes a lot of sense to re-leverage debt, or other times you'll be forced to because your term is going to expire. When we underwrite deals, we look at it from multiple different lenses. So we look at it, what happens if we exit? What happens if we refinance? What happens if we refinance and then exit? What happens if we recap the deal? So we slice it a bunch of different ways up front and then see which one has the highest potential for investors, and we go after that. However, because we've looked at it from so many other different slices, we can have a plan A, a plan B, a plan C, a plan D, so that if the market moves or some storm or external factor is happening, we can pivot and adjust, and we know how to do that.
Okay, so I remember, yesterday we've been hanging out.
Yeah.
And you told me that you have a couple of deals with good rates, like 2%, 3%, something like that, right? So have you been dealing with a deal that say that, the rate is so good, you don't want to exit that rate, but you need to either refinance or raise capital to save or keep the debt that is on the deal?
Yeah, actually, so my deals are under 3%, so don't tell me they're 3%. They're 2.59, 2.77. You can't beat it. I'm joking, but to answer your question, yes, I had a deal that I exited, this is 2025, so I exited it last year, and it had fixed rate Freddie Mac debt on it, and the interest only component was expiring, but the debt was still really good. And instead of waiting to exit, we actually ended up exiting it slightly early because the NOI had already reached a certain level. Cap rates were going up, meaning that we were going to start seeing the value drop. And more importantly, what I realized when I analyzed it and underwrote it was that if we continued to hold it, we would have needed to raise more capital to cover, because now the principal and interest kicks in, or the principal part of the PITI kicks in, because it's no longer interest only. So we would have had to raise more capital. We wouldn't have been cash flowing for our investors like we had been for the last 4.5 years. And we would have had to put a lot more money in to renovate it, to bring it up to market, to hope to try to exit it in another 2, 3, 4 years, where we were able to exit it now. So it didn't make any sense.
It didn't make sense.
So when you look at it, and you look at the numbers and the math behind it, the answer usually becomes really clear what the best outcome is. Now, you can't always do that, right? Sometimes there's an external factor or something else that prevents you from going after that business plan, but at least you can look at what's possible and what's achievable.
Okay, so and now that you're talking about business plan, so you do the business plan before acquiring the asset. But part of the business plan, you have your I guess plan B, plan C, plan D. You know, if something happened like the interest rate, when it changes 2 years ago, things like that, right?
Yeah, absolutely. We always have multiple exit plans that we're at least considering. We may not go after them, we might not plan for them, but we at least know what they look like and what options are.
Yeah, definitely. Okay, perfect. So what negotiation tactics do you use when sellers refuse to budge on price, but you know the deal won't work under their terms?
Oh, that's a good one. Well, if I tell you, I'll have to kill you. Just kidding. I'm just kidding. No, so actually it's shifting focus away from price is the best way to do it. So I'll tell you a story about a deal that I closed. It was in Orlando. Let's see, it was 296 units, maybe 396. I don't remember. It's between 300 and 400
What was
units.
the acquisition price?
I'm going to tell you what the acquisition price was, in fact. So we ultimately ended up buying it for just under $52 million. Now, this was years ago when you could still buy that many units for $52 million in Orlando. This is like Class B value-add asset, and the seller didn't want to sell to us because we were like the third highest bid. And this was back when you'd get 25 offers on an asset and you had to like really compete. So I call the broker up, and the broker says, look, he's not going to give it to you because you are $1 million below the highest offer. So you got to come up. And I said, I can't come up. Other than price, what's going to make this seller sell? Right? This is a sentence you guys should learn. Other than price, what motivates the seller? Okay. And the reason you ask that question is because you want to know, forget price, pretend like you get your price. If you have two identical offers on price, what is the thing that is going to move them? In that discovery process, what I find out from the broker is the way that the seller is structured for their investors, they don't want to pay the transfer taxes and the doc stamps. I don't know why. It's something about how they get paid in the deal if they have lower closing costs, something like that. So this was a pain point for them. None of the other groups bothered to ask this question. So what I did was I went back to the table. I reduced my offer by $300,000 because that's how much the transfer taxes and doc stamps they would have to pay are. So I reduced my offer and said, but I'll pay your transfer taxes and your doc stamps, and our net total cost is still the same amount of money. And they came back to us. They asked us for like $50,000 more.
Which is nothing.
On a $52 million deal, this is like a rounding error. And we got the deal under contract. We closed it. We exited that in 2022, made a healthy return, double-digit return for our investors, and that's how you get better deals, and how you get deals you wouldn't otherwise get is by considering what are the other factors outside of price that are important.
I love that because you thought out of the box.
Yes.
When traditionally, or maybe most people, they're thinking about prices only.
Yeah.
I'm going to target, a better price, and that is going to be my only tool, to get the deal.
It's a great tool when you have more money to spend, but sometimes you can't pay more for it. And that's when you can start thinking about these other ways to look at deals. There was actually a deal I made an offer on, also in Florida. I don't know why all these happen in Florida, but it was in Florida. It was a much smaller multifamily asset, and it was going to be a creative finance, like seller finance deal. Mom and pop owned it, also immigrants. And they came and they said, yeah, we're in our 80s, we're ready to retire. I said, amazing, tell me your pricing. Pricing wasn't the issue for them. They had such a strong emotional attachment to this building because it was their life's work. They moved to this country, they raised their kids. All they did was invest their time and energy and effort into this building that's now worth millions of dollars, so it's not a bad plan by any means. But they just couldn't let this property go because they were emotionally attached to it. It was their baby. So afterward, I went back to the drawing board because I really like to structure. This is like my favorite thing. And I'm like, okay, Veena, you know that this is legacy for them, and that's why they're not willing to move on this. What can we do to get them excited about it? So I went back to them. I kept the offer the same because it was actually a very fair offer. It was, fair for me, maybe not so much for them, but it was a fair offer. They were okay with the number. They just didn't want to let it go. And I went back to them and I said, hey, we changed the terms of the LOI. I presented a new LOI. In there, I added a term that we are going, as soon as we take over, within the first 90 days, we're going to rebrand to their last name estates.
Oh, wow.
Right? So if it was like if I was buying from Veena Jetti, I said, we're going to rebrand it to Jetti Estates because this is your legacy. Everyone in town knows that this is your asset. We don't want to change that. We just want to come and take it off your hands, operate it a little better, revitalize it. They were so excited. The wife was like almost in tears when we told her this because it's the idea that you can sell the asset, you can still get the financial freedom that you built over all these years, and also keep the legacy that was, because I don't care what the asset's called. For me, it's, I like the name that's going to bring the most renters with the most money, right? Like, it's the same thing when we paint our assets. People are like, oh, that's so fun. You get to pick the colors that you love. What's your favorite color? And I'm like, the one that gets the most rent. I don't care if it's blue or purple or green or brown. I don't care, right? I'm not going to live there. Now, in my own home, I'll make different decisions, but for investment properties, it's not an emotional decision for us.
I love that. When you, let's say, because you're doing deals right now in Florida, Texas, Georgia,
North Carolina.
North Carolina, right?
Yeah.
So let's say,
did you say Arizona? I'm doing
in Arizona.
Yeah.
That's right. Yeah. Okay, so I had a question, but before going that route, will you consider a new state at this point? Yeah,
absolutely.
Okay,
yes.
Perfect. So let me ask you this: let's say that you have a deal coming from a state that you don't have investment right now in. When you are analyzing a market, it's a new market for you. It's a new city. You like the deal, but it's a new city, it's a new market, right? And what are the key factors that you're focusing on? For example, when I am analyzing, Alexis, I analyze population growth, vacancy rate, average household income, average rate, unemployment rate, tenant versus owners ratio.
Oh, okay. But wait, tenant versus owners in what? In condos?
No, how many people owns versus
in
rent
the 1 mile radius. Okay, yep. We look at that
it's not a deal killer, that ratio, but at least it gives me an idea.
To know. Yes, I agree.
So, what indicators do you analyze and why, and which ones do you consider the most critical for decision making, and which can be misleading if not interpreted correctly?
Ooh, well, they can all be misleading if not interpreted correctly, right? Underwriting is an art and a science. It's not just a science, right? You can make the numbers say whatever you want them to say. If I charge you $20,000 a month in rent, I'm going to look like I have the best returns ever. The question you're asking is it achievable, right? So from the indicators that we look at in a new market, it's all of the ones you stated, and then the one that I think I would add, and I'm pretty sure you look at this too, you just didn't put on your list, is diversity of job sector.
Yes, absolutely.
So I don't like to invest in areas like Fargo, North Dakota is a really good example. If you look at all the statistics, it's got the growing population, it's got job growth, it's got job stability. The housing market has like quadrupled in a very short amount of time. The demand is there. But Fargo, North Dakota is booming because of oil. And so what happens when we shift to more clean energy? What happens when the price of the barrel drops, right? These are all questions we have to ask. And so I like to know that there's multiple job sectors, because even if oil isn't doing well, medical might be, tourism might be, right? Agriculture might be, industrial might be. So I want to look to those. And then I also want to look for a heavy presence of Fortune 500, Fortune 1000 companies in the proximity of where I am. So one of our assets we bought, when we bought it, Apple had just announced that they were releasing a $1 billion campus within 20 minutes of my asset. So what that means is Apple employees can now come live at my asset, and I know they can afford to pay rent. So I care about things like that when I'm looking at deals and markets. Now, for us to enter a new market, it actually takes us a lot to do that. So I get great deals all the time. I get some deals like in Ohio, right?
Yeah.
And I like the Ohio market. I own real estate there, but I don't have multifamily there yet.
You own a hotel.
I own a hotel
in
there.
Ohio.
Yes, in Middleton, Ohio.
Middleton, Ohio.
Middleton, Ohio. I've never been there, but I own it. What I do when I get an Ohio deal that looks like a pretty good or decent deal is I go, thank you so much for sending it to me. This is not on our current target list. Here's my friend Alexis who can buy this deal in Ohio, right? And I'll send them to you or you and Sarah or whoever, right? That you guys can work together on this deal. Because if you focus on everything and you get shiny object syndrome, you will never be a master of your market. So for us to enter a new market, we're actually studying and looking at it in the background quietly for 12 months at a minimum.
Wow.
So I know our market. So right now, and I can tell you.
So what do you do in 12 months? I mean, you're studying it, but
We're underwriting deals to see how they're trading. We're looking at what cap rates are doing. I'm looking at what job growth is looking like. I'm looking what population trends are like. Are there laws that are coming out that are changing the nuance of those submarkets, right? So other states I like that we are not currently invested in or don't have in our targets. This is like the secret list that we're looking at behind the scenes. We like Nevada. We like Indiana. We like Ohio is on that list. Trying to think, did you say South Carolina already? Because that's on our target.
because you're in North Carolina.
We're in North Carolina. So we like South Carolina too. So you'll notice there are also states that tend to be more landlord friendly. I don't like to invest in areas that are rent controlled because there's a lot more nuance and risk for our investors in that. Does it mean that you can't make money in those markets? Of course not.
But it's more difficult.
It's harder. But I always say you have to pick your specialty and then just double down into that. You can make money a million different ways in real estate. You can do Class A, you can do Class B, you could do land investing, you could do fix and flips, you could do new construction, you could do heavy value add, you could do core plus. It just depends on what is right for your investors, and that's where you should really focus.
Well, that answer makes me feel that I need to slow down a little bit.
Why? What are you doing?
Well, it's not that I'm taking down any deal that comes across to me, but I feel that I submitting too much
many offers.
Yeah.
That happens early on. So especially when you're at like the tip of scale, which I think you're there right now, what happens is you go, oh, but if I can get that 100 unit.
Debt cost versus cap rate. Oh. So how you determine if it is worth taking on higher interest rate debt in markets where cap rate haven't adjusted enough?
You mean it hasn't expanded enough?
Yeah.
I don't like it.
Why?
Okay, so what we're talking about, right, is going into a deal with a 6% interest rate where cap rates are at 5%. When you do that, you're going into the asset negatively leveraged, and I don't like that.
You haven't done it before?
No, I'm trying to think. No, I take that back. I take that back. We have done it before.
But just underwrite it, or
on adjustable rate debt, when you have a long interest only component, it will cash flow. But recently we have not done it because it's just too risky.
It's too risky.
In this part of the market cycle, it's risky. 5 years ago, different story.
Everybody were hoping, the interest rate come back down, and that hasn't.
We're
happened
starting
yet.
to see it a little bit.
Yeah, but not. I think that not as we were expecting, right?
Oh yeah, I mean last year everybody said survive till 2025, and we did. And now what?
Yeah.
Where are the interest rate cuts, right? Well, the stock market has been crashing. Crypto is doing its thing, fluctuating up and down and up and down. The good news when the stock market crashes is investors seek safety in
They buy
bonds.
bonds,
Exactly. And when the bond pricing comes down, interest rates also tend to follow and correlate with that. So I do think we're going to start seeing some amount of decrease on interest rates. We've seen a little bit. I think we'll continue to see more, but I don't know how much it's going to be. And I think that there's a bigger concern just with pricing in the market right now because, I'm getting whiplash from like, we have tariffs. No, we don't have tariffs. I have tariffs. No, we don't have tariffs. We're going to put tariffs on you. They're going to put tariffs. It's every day it's something different. It's a lot to keep up with. And the problem is when you have tariffs or any kind of uncertainty in the market, investors don't like it. They get scared, and that's why we're seeing this movement. Warren Buffett is moving to the largest cash position that he's ever had because he too thinks that this is opportunity. So even though this is happening, this is opportunity for people like us.
Do you think that if the investors put more capital on debt, the Fed at some point will feel forced to drop the interest rate a little bit?
Oh gosh, well I didn't bring my crystal ball, so it's hard for me to say.
From the technical side of it.
The thing that's hard, right, is you can't look at it in a vacuum like that, right? Because there's other factors, like the inflation report in January said we saw an increase in inflation. Pricing hasn't come down. So it's really tough to say what the Fed is going to do. The challenge is the Fed funds rate is one of the few levers that the Fed has to try to cool down inflation and to stabilize the market. So, it's a lever that they pulled pretty significantly over the last 2 years. And I do think they're going to at least plateau or start coming back down a little bit.
Nice.
From my mouth to Jerome Powell's ears.
Institutional versus individual investors. How does your strategy change when working with capital from family offices or large funds compared with individual investors?
So large funds, institutional funds, family offices, high net worth investors, they are much harder to raise capital from, rightfully so, because think about it, they get 1,000 deals every day. And they only want to invest in the best because they have so much opportunity. And they literally have people who are there to gatekeep, right? Like that's their job. They're paid to gatekeep. So if you're going to try to raise from institutional, family offices, et cetera, come with a lot of knowledge, a lot of relationship building skills because it is a relationship game. And they're not going to move fast. They're not going to feel pressure. They're going to say, yeah, we're going to take our time. We're going to get to know you. Maybe we're going to come see your setup. We want to meet your team. We want to see one of your assets with you. So the larger the family office, the larger the institution, the more due diligence they're going to want to do on who you are as a manager.
So they're betting the jockey,
they're
not the
always
horse.
betting the jockey, not the horse. Retail investors, sophisticated retail investors are betting on the jockey too. But the difference that you're going to see is when things go sideways or not according to plan, or you're not raking in money like we were in 2020. I was pointing at a map and making millions and millions of dollars from that, right? Today, we're not in that market. And what happens in this part of the cycle is retail investors get more scared. It's interesting because they tend to move inversely with each other in a way. It was much harder to raise from family offices and high net worth investors 3 years ago, 5 years ago. Today, it's much easier because they see the opportunity, so they're moving into the market quickly. This is what Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Right now, retail investors are scared. They're pulling back from the market. They're not investing as much. They are nervous. They're maybe getting crushed on other deals that they're invested in. Maybe they're getting capital called. They're losing principal. This is part of a market cycle. Savvy investors understand that this is part of the risk. Retail investors pull back from the market when that happens. So right now, if you're investing with, or you're raising from retail investors, you need to have a really good story. You need to really understand what their goals are. You have to make sure you're mitigating risk every turn that you can. And these are just good practices, quite frankly, in any part of the market cycle, but you need to be able to articulate them in a clearer and better way. Focus on the downside, let the upside take care of itself.
Now that makes me think, if at some point I would like to raise capital from family offices, I think that, as a Latino person, English is our second language.
Yeah.
And now you mentioned that we have to articulate the words correctly.
Yes, you do.
So what does that mean? So do I need to improve the multifamily wording, let's say, or?
No, raise money from Spanish-speaking family offices. Latin America is a widely untapped resource. South America, widely untapped. And there are people that have millions and millions and millions of dollars. Millions of dollars, billions of dollars. No one is speaking to those people. You should be speaking to them.
And they want to put their money here in the U.S.
Absolutely, because this is a safe haven for currencies that are more destabilized than the U.S.
Especially with different politics or presidents that are taking over, in these countries.
Yeah, and that's why there's so much instability. They don't know whether the peso or whatever their form of currency is going to be worth the same amount in a month or a year. And to be frank, that's true for any currency. But the U.S. is the reserve currency of the world. So it's a store of value. There's more stability in the dollar than there is in some of these other comparable countries. Even the same for India. The rupee has gone down in value compared to the dollar over years. When I was young, maybe like 20, 25 years ago, the rupee was 45 rupees to $1. I was just in India last month and it was 87 to 1.
What a huge difference.
Yeah.
Syndications versus funds. I know you do a lot of syndication.
Yes.
Have you explored the idea to launch an equity fund or a debt fund?
Yeah.
Why or why not? And what would be the strategic advantages and disadvantages?
Okay, so the answer is yes. I've looked at both a debt and equity fund. Yes, we've gone through the exercise of doing one of each. We did launch an equity fund. So I have Rev Fund, which we launched as a $100 million equity fund. The purpose of doing a fund is to diversify the risk for investors. So if you are a single family investor or you're a fix and flipper, right, you might come and try to find a single investor to invest in this fix and flip at 123 Main Street. And let's say you come to me and you say, Veena, I need $100,000 to do this project. We're going to make all this money. It's going to be great. We're going to move to Sri Lanka and live on the beach, right? But I have to take on a lot of risk because if that project fails, then what? Right? But if you come to me and you say, hey, Veena, I have these 10 houses. They each need $100,000. You give me $100,000 and I'm going to put 10,000 here, 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 and here. Well, guess what? Now my money is diverse. And if project A fails, it sucks. I don't want that to happen, but it's much less painful than if all of my eggs are in one basket. So the benefit of a fund is to be able to diversify. The other benefit of a fund is to give your investors options. So they might not want to invest in project A, but they like all the other projects that you put on the table. So they may say, okay, you know what, 10,000 in there is not that bad. And now they can get the benefit of being in other projects that they like. So really diversification is the biggest benefit.
I remember when we were in Puerto Rico, we did the hotel summit in Puerto Rico, and we went to Jerry Norton's house. At the time, I didn't know about what a debt or equity fund was. And that was actually my first exposure to that term. But I remember that you told me that one of the good advantages of a fund that you can split it in different shares, and you can use, like, for example, shares A for multifamily, shares B for hospitality.
Yes.
Can you elaborate more on that?
Yeah, so you can do that. You can also split shares in a syndication too. So you can do it for both. In a syndication, what that would look like is your Class A shares get a different waterfall. So you get 7% and 70-30 in Class A. In Class B, you get 10% and then 70-30. In Class C, you get 15% and then 80/20 because you invest over $1 million. So you can really customize your different share classes. We do that in our syndications. In a fund, you can absolutely parse it out and say, hey, A-class shares are for people who want hotel exposure. B-class shares are people that want single-family exposure. C-class shares are for multifamily or whatever it is, right? And so now what happens is, as an investor, you could come to me and say, hey, I want 50,000 in Class A, 30,000 in Class B, and 20,000 in Class C. And now you get to choose the different allocation.
I didn't know that. I thought that, well, the idea that I had in mind is that, okay, see, if I'm going to pitch an investor, I have like different options for him. You can invest with me in
Or
the
her.
hospitality, or her, yeah. Or you can invest with me in multifamily, for example, but I didn't know that they can invest, let's say 100 grand, and you can split those in different.
Yeah, you can.
Interesting, interesting. So what are the most effective quick wins to increase NOI within the first 6 months after closing a deal?
Oh, okay. So quick wins to increase NOI. My favorite one is reserved parking.
Okay.
So what you can do is you can go, so let's say you have 10 units in this building, right? You go and you take a stencil that says reserved and some yellow spray paint, and you spray paint
Something
The
so simple as that.
less than $10.
Wow.
And you spray paint reserved parking on the premium 5 spots in front of the unit. Okay? So now what happens is when you reserve this parking, the tenants that are used to parking there go, oh, now I have to park all the way 70 feet that way? And they hate it, right? So then you say, oh, no, you don't. Would you like a reserved parking spot? Now, here's what I love about reserved parking. It's a great way to add concessions without adding an expense to your T12. What do I mean by that? Hey, Alexis, you want to move in? You're like, oh, you know, I'm thinking about this and the property down the street. They both look really nice. Rent is comparable. Your place is a little bit nicer, but I think I can get $25 less there. And I say, oh, hey, I'm happy to give you a reserved parking spot. We normally charge $40 a month for it. I'm going to give that to you for the first 6 months that you're here. Oh, and by the way, if you want to renew it and do it ahead of time, come in anytime between today and month 5, and I'll renew it for you for $25 a month for months 7 through 12. So what happens?
You're saving the concession and you're increasing the NOI.
You're saving the concession, you're increasing the NOI, and I'm giving you 6 months to get used to taking your groceries from the front middle spot into your unit, and then all of a sudden you can't park there anymore. And then and people are creatures of habit. And now you have to park 10 spaces over. And you go, man, these groceries are really heavy, right? So that's a really good way. I think reserved parking is overlooked a lot. I also really like something intrinsic that doesn't necessarily directly affect your bottom line, but it will indirectly, is creating a community. When people love where they live, they tell other good residents to come live there. And good residents are really the heart of any good community. You decrease crime, you decrease littering. It's a good setup. So investing into resident events is a really good way to do it. You can work with local businesses to create partnerships with them. You could ask a food truck to come hang out for a couple hours while you do, a planting event. We've done that at some of our assets where we buy a bunch of flowers from like Lowe's or Costco or wherever, and we bring them, and then all of the community comes out and we plant them in the front. It beautifies the community. It also creates like a bonding event. We get a local vendor to supply us with like some pizza or tacos or whatever, and it's just a really great event. And we take pictures, we post on social media, we get everybody excited about living there. We do grab and go breakfast where we put like donuts and a juice box and water bottle in a bag and send them with that as they're leaving. We give them the bag so they have breakfast on the go. So there's a lot of like different small things you can do to create a cohesive community.
I love the parking one though.
Yeah, it's good. I know, it's my favorite one.
So when you enter in, because now you have your team, you have property managers, you have asset managers as well?
Yes.
Yeah, okay, perfect. So, but let's say that you're entering into a new market and that you have never operated before. How do you find and evaluate a new property manager? Do you interview them? What question do you ask in the interview? What red flags will make you eliminate a candidate?
Yeah. Okay, so here's the thing about third-party property managers. you got to pick your poison. There's not one single company that's like, oh my gosh, this is the best property manager that's ever been. And the secret to having well-run assets is making sure that your asset managers are managing your property managers. You have to micromanage them. And I hate that because I hate micromanaging anyone. But if you don't do this, they don't care about the property the way that you do, right? And there's a difference between asset management and property management. And yes, we interview them. We actually go through a pretty extensive process. So we do what's called like an RFP process, where we ask 3 or 4 larger, well-known property managers. Usually if you can get a referral from someone, that's really beneficial because they'll tell you the good, bad, and the ugly, so you'll know what poison you're about to drink. But you can go and you can ask them for a proposal. They will put together a budget. They will give you a proposal. And by the way, before you acquire the asset is when you're interviewing the property managers. It's not after. It's during your LOI phase, because you need to know if the assumptions that you're making on your pro forma is something that they're going to be able to achieve. Maybe you've underwritten for a $500 increase or premium, and then the property manager you select is like, no, we can only do 200.
Which is happening very often.
It happens all the time. So what we do is we ask them to send us their budget and say, okay, are these the numbers that are achievable, or are you just putting this out here to sell us and to make us go with you? And they say, no, absolutely, we can do this. So we always try to tie some kind of incentive to the numbers that they put out, so that if they don't meet them, I can go to them and say, hey, what happened? And they can, oh, well, it was just too aggressive. You gave me these numbers. You told me you could do these, so what's happening, right? Course correcting, asking them what that looks like in the deal, once you're in the deal. If things are not going as you plan, what remedy do I have? How can I course correct? Who can I talk to? How will we replace people? Asking them what hidden fees there are outside of the normal 3%, 10% for smaller assets, 3% for larger assets, sometimes even a little less for larger assets. What are the other fees? Because you'll find things like training fees, uniform fees, software fees, admin fees. So you want to understand what the world of that looks like, so that you're not just going with the lowest priced, you're looking at the holistic picture. And I actually have a whole list of questions that I ask property managers, so I can get that to you after too, so you can have it.
I love that because, well, you know how the game is.
Oh yeah.
With them. Asset management. You said that you have asset managers.
Yeah.
What key performance indicator do you review weekly or monthly or whatever you meet with them? With property managers to ensure the business plan is on track?
Oh, we review weekly. Weekly, and sometimes more than that. If we start seeing it kind of veer off, we start looking at it almost daily sometimes. It's harder to look at it daily because there's so much fluctuation. You don't really get a good picture, but we still watch it. So we're looking at how many notices to vacate are there, how many evictions, where is bad debt. We're looking at what's our occupancy, what's our 30-day occupancy, what's our NOI, where are our collections. Are there any contracts that are over budget? Is there anywhere that we can cut costs by renegotiating a contract? What are different ways that we can increase our community outreach? What are residents saying to you on a weekly basis about what they love? What are they complaining about when they're leaving the property? Let's say they don't renew. I want to know why you're not renewing. Are you buying a house? Are you going to another property? How long have you been here and you're moving after 6 years? What happened? Usually in those situations, it's because they either can't afford it, they're moving in with a boyfriend, girlfriend, spouse, whatever, getting a divorce, or they're buying a house.
KPIs that aren't numbers related, do you evaluate them by property, like individually, or as an overall portfolio?
We both.
Or both?
Both, yeah. We really drill down into each individual asset, and the way we use the overall portfolio is we take ideas from that are working at one asset and move them to test them in another market or another asset, or we'll say, oh, okay, we're seeing a trend of an increasing number of residents saying that they're going to buy a house in Atlanta. What's our other asset that's 5 miles away doing? Is it doing the same thing? Are we seeing the same trends? And we'll take it a step further where I'll pick up the phone and I'll call one of my friends. I'm in a peer mastermind where all of us have transacted on over $1 billion of assets. There's like 10 of us in it. I'll go to them, or I'll pick up the phone and I'll say, hey, what are your Atlanta assets doing? Are you getting this on NTVs? And they'll tell me, oh yeah, we're seeing this too. Or, hey, what are you doing to mitigate against this? Or what are the strategies you're employing? Because this is not competitive, this is collaborative. And when we help each other, it's a team sport. When we help each other, we all elevate and do better for our residents, for our investors, for our communities that we're investing into, for lenders. Everybody wins.
What are your goals in 2025, 2026,
I knew you were going to ask me this. I knew you were going to ask me this. Okay, I'm struggling right now, if I'm being honest. So last year, end of last year and beginning of this year, I actually went into like really intense burnout, which I've never been in before. So it was like very new for me. My daughters would say I'm failing at something, but it was hard for me. So I went to India for a month. I was still working while I was there, but it gave me a moment to like kind of recharge, reconnect. And since coming back 3 weeks ago, I think the thing that I need to really shift my focus to and double down on is the legacy of what I'm doing. It is very important to me that we have more women and minorities operating in those higher levels. And what I've realized to be true, and I've always felt that, and I've always talked about it, you know that, I've always leaned into that. I've always been a little bit hesitant though, because, well, I'm a woman of color in these spaces, and there's not many people that look like me. And so I didn't feel like I could say those things and I could advocate in the way that today I'm like, wait a second, I've done $1 billion of transactions. How is anyone going to tell me who should or shouldn't be in the room? And so if I don't say these things and I don't advocate for these things, who's going to do it? Right? And so I want to really use my privilege and my position of power to be able to share with other people, my peers, my friends, people I respect and work with and partner with. I want to be able to show them the power of what women can do and why it's important to have women's perspectives in the room. And so then I thought about it more, and when I was in India, this kind of realization came to me that it's great to want women operating at this level. And if you think about why we don't have women operating at this level, it's not because they're not capable, it's not because they're not smart enough. They are absolutely powerful and deserve to be there. But it's because we don't give them a pathway to be there. So now what I've kind of shifted my mission and my focus to is making sure that I'm in rooms where people are just starting, where they've maybe done 0, 1, 2, 3, 5, 10 deals, where they're just starting out, and making sure that I'm there in those rooms to help them, to give them the knowledge that no one gave me. I had to learn all of this on my own. And so focusing on those entry-level and mid-level positions is how I create the pathway that these women and minorities can then grow and achieve greatness and get to those rooms. So it's a long-term vision. It's selfish because I'm raising 2 brown girls, and I want them to know that they not only deserve to be in these rooms, they belong there. And that's important for me.
I love it. Veena, it's been an honor.
Thank you.
Thank you so much.
Thank you.
You're the best. This is so amazing.
Thank you. Thank you for doing this, and for all of you for being here. This is really in alignment with what my goals are looking forward, because I'm in this room and I see a room full of diversity and full of perspective and full of opportunity. And so I'm really excited to learn, not just from you, but from everybody here, because you have different experiences that are so valuable. And when I can learn from those experiences, I can show up better for my team, for our residents, for my kids, for my husband. And so thank you for letting me be in this room.
Thank you.
I'm so grateful.
I really appreciate it.